Right then. Well, without too much fooling around, let's jump into chapter 18 today. And today we really just have one big topic: exchange rates. Sorry, my computer is acting up. Hopefully this thing is not. We'll see. Things seem to be working a little wonky here on my end. Okay, so this is the big topic of the day. Pretty much everything that we talk about today is going to be centered around this topic of exchange rates. So I don't know if any of you are big travelers or to what extent that you have familiarity with exchange rates. One of the things about being an American is largely Americans, don't have that much familiarity with exchange rates. But nonetheless, exchange rates are a very important thing to understand, not only from a macroeconomic perspective, but just from a business perspective, right? You got to understand exchange rates and why exchange rates move so much. Now, when we talk about exchange rates, we're talking about what's called the foreign exchange market. Or usually in the finance lingo referred to as the FX market. This is the largest financial market in the world. There is no physical location for the foreign exchange market. It is basically a network of traders, usually associated with banks, that trade electronically. So there is no physical location. There's nowhere you can go and see the foreign exchange market, right? These are huge markets. About $1 trillion a day is traded in these foreign exchange markets, right? That's a lot of cash. And just to give you some idea of how big these are, usually the minimum trade is $1 million. You're not making trades less than $1 million in these foreign exchange markets. So, this is not like for day traders. Now, day traders can get involved in the foreign exchange market. There are ways that you can, as we're going to talk about. I think that's kind of a uniquely stupid idea, but but yeah, as I said, most of the people who are trading or involved in this foreign exchange market are professionals. Most of them associated with major banks, and so they're doing their trading for their bank, but also for the bank's customers. Okay, and so these markets are very competitive. Right? If you think about a perfectly competitive market, the foreign exchange market would be a very good example of a perfectly competitive market. There are a large number of buyers and sellers, and what are they selling? They're selling a homogeneous good, currencies, right? Currencies. That's basically what they're selling. Dollars, yen, pesos, right? Those are the kind of things that they're selling. In these markets, there is a price, and that price is known as an exchange rate. And all an exchange rate is the price of one currency in terms of another. Right? The price of one currency in terms of another currency. So let's think about, actually, let me say it this way, the dollar exchange rate. The dollar exchange rate, which is, your book refers to this as XR, okay, the dollar exchange rate. What is the dollar exchange rate? The dollar exchange rate would be how many of another currency you get per dollar. So for instance, it would be the number of euros you get per dollar. That would be what we call the dollar exchange rate. The number of euros you get per dollar, or the number of francs, or I'm sorry, the number of yen you get per dollar, the number of won you get per dollar. What then would be the euro exchange rate? If you're given the dollar exchange rate, how do you figure out what the euro exchange rate is?
How many dollars you get for every euro?
How many dollars you get for a euro? In other words, it's just the inverse of this, right? It's just the inverse of this. What happens when the dollar exchange rate goes up? We would say the dollar appreciates. Versus the euro. Or another way you could say that is that the euro depreciates against the dollar. So instead of saying price goes up and price goes down, which honestly would make probably more sense, we tend to use these words appreciation and depreciation in terms of exchange rates. But the key that I want you to understand is that the exchange rate is just a price. It's just a price determined in a competitive market. So if it's a price, what determines the exchange rate? Supply and demand, right? Supply and demand. What determines the exchange rate of the dollar? Supply and demand for dollars. So there is a foreign exchange market for dollars. There's a demand for dollars, and there is a supply of dollars. People wanting to buy dollars, people wanting to sell dollars. There's a quantity of dollars sold, and then there's the price for dollars. And what do we call that price? The exchange rate, right? So the exchange rate here is basically the price that equilibrates the supply and demand for dollars in the foreign exchange market. So this is just simple supply and demand stuff. And honestly, supply and demand supply and demand in a perfectly competitive market is a very good description of how these markets work, right? Because as I said, they are extremely competitive markets, right? Extremely competitive markets. So kind of simple supply and demand analysis, is a good way to think about what kind of things drive the US dollar exchange rate. So what happens if we have something that increases the demand for dollars? What will happen to the value of the dollar? It goes up. And what do we call that? An appreciation. The dollar would appreciate. How would this impact other things that we've talked about here? For instance, how would this impact our trade balance? If the dollar appreciates, what does that tend to do to our exports and imports?
There's going to be more imports, right?
There's going to be more imports. Why would you say that, Gabe? Walk me through your intuition here.
I was just thinking, like, if the value of our currency goes up, wouldn't that mean I might have confused it.
No, not necessarily. So what happens when the dollar gets more expensive? Remember, the flip side of the dollar getting more expensive is that other currencies get cheaper. So let's think about this. What happens, first off, to the price of US exports?
They go down.
They go down, right? The price of US exports go down. Okay, when the dollar appreciates, you have to give up more euros per dollar. So from a foreigner's perspective, what's happened to the price of exports?
It's gone up. My
It's
bad.
gone up.
Yeah.
And the flip side of that is it reduces the price of imports. So you tend to see exports go down, imports go up, and what happens to your trade balance? Well, let's put it this way. You tend to see your trade balance fall. Okay? So an appreciation of the currency tends to reduce your trade balance. Also, what does it tend to do to your capital flows? If your trade balance goes down, how do you pay for that? Do we do more borrowing from abroad or less? What do you think, Noah? If our trade balance goes down, how do we have to pay for that? Meaning we're importing more than we're exporting.
Can you say that again? I didn't quite hear it.
So what happens to our net foreign savings as a result of this? Do we save more abroad or do we borrow more abroad when we have this trade balance, a fall in our trade balance caused by a fall in the or an appreciation of the dollar?
How do we save more?
Save more because remember, the fall in the trade balance means that our exports have gone down, our imports are gone up. So we're having, for instance, running a bigger trade deficit. To pay for that deficit, we have to borrow more, right? So exchange rate plays a direct role in what happens to your trade balance, what happens to your capital flows, right? One of the reasons that it's important for us to understand this is there's this really weird thing that goes on when politicians talk about the exchange rate. Is all politicians say, we want a strong dollar. Right? I heard Donald Trump used to say this all the time. We want a strong dollar, right? Strong dollar. It's kind of a weird thing to say, quite honestly. Is a strong dollar good? Is a strong dollar bad? It's neither, right? It helps some people, hurts other people, right? A strong dollar helps importers. But it tends to hurt exporters. It's neither good nor bad. but it does benefit some people and hurts other people. It also tends to help holders of US assets. Because if you hold dollar assets and dollar appreciates, those assets are going to be worth more. But then who's it going to hurt? Foreign assets. Those who own foreign assets are going to be hurt by this. So this strange idea, and maybe you had this in your brain too, is that, you know, somehow a strong dollar is a good thing. Like the dollar is like some sort of measure of our national manhood or womanhood. That's a really dumb way to think about the exchange rate, right? It's just a price. An increase in the price helps some people and it hurts other people. A decrease in the price helps some people and hurts other people. I mean, you never hear people say the price of apples is strong. That's a good thing. What do you mean by the price of apples is strong? No, prices go up or they go down, right? It's the same with the dollar, right? You got to think of this as just a price. So if the dollar goes up, that's not necessarily all a good thing for an economy. It creates some winners and losers, right? In particular, if you're worried about your trade balance, a strong dollar is not a great thing. And in fact, as we'll talk about here in a little bit, one of the things that's been driving up the US trade deficit is the fact that the dollar has been appreciating here over the last year. And we'll talk about why that is here in a minute. But yeah, you know, don't fall into this trap of thinking that, you know, a strong dollar is good or a weak dollar is bad. Of course, it's good for some people. I didn't mention this here, but who else is a strong dollar good for? Tourists, American tourists. Right? American tourists, because we can go overseas and buy a whole bunch of stuff with our dollars. That's great. So as somebody who loves to travel, yeah, I love a strong dollar, right? That's great because it means I can buy more stuff with my dollars. But, you know, you don't want to fall into the trap to think that this is like somehow a measure that the economy is good or that everybody benefits. Let's talk about some of the major factors that influence exchange rates. And we can really separate this into two big categories. Things that shift the demand for dollars, and then we'll talk about things that shift the supply of dollars. What are some things that shift the demand for dollars? Well, if you follow the financial news, right? If you read the Wall Street Journal, every day in the Wall Street Journal, they have what's called the FX column, right? Which is basically kind of a recap of what's gone on in foreign exchange markets over the previous day. What kind of things do you see showing up in there? Well, there's really, I would say, 4 primary things that tend to drive the demand for the dollars, or really the demand for any currency. The first is relative interest rates. Relative interest rates. Okay, now here's I don't want to say this is difficult, but it's just one of the things you have to constantly keep in mind here when you're talking about exchange rates. Exchange rates are a price of what's happening in the US relative to another country. So you can't think about anything related to exchange rates without thinking about them in relative terms, right? It's not the interest rate in the US that matters. It's the interest rate relative to what it is in other countries. That's what matters. So for instance, if interest rates go up in the US and they go up by the same amount in Canada, that will not impact the exchange rate because the relative interest rate has not changed. But if interest rates go up in the US and they don't change in Canada, now the relative interest rate has changed. Higher relative interest rates in US will increase the demand for dollars. Why? Because it's going to increase the demand for US assets. And it will increase the demand for dollars. So when interest rates go up in the US, now dollar assets look more attractive. More people want to buy US Treasury bonds. More people want to buy US corporate bonds because now they're paying higher relative interest rates. So what will happen to the value of the dollar? The dollar will appreciate. Right? The dollar will appreciate. What if I told you that instead of interest rates going up in the United States, interest rates went down in Europe? Does that change your answer? No, it's the same answer, right? Interest rates going up in the US is the same as interest rates going down in Europe because the impact is the same. Relative interest rates have gone up in the US. Okay, so you have to think about this all in terms of relative, right? If interest rates go up in both countries by the same amount, nothing has changed in a relative basis, right? So you got to think about what's happening to interest rates in the US relative to other countries. So when interest rates go up in the US, that really makes US dollars more attractive because if you get those US dollars, then you can buy US Treasury bonds or US corporate bonds or whatever kind of, you can put money in a US bank and get a higher interest rate. So we tend to see one of the things that definitely drives the value of the dollar is changes in interest rates, not just in the US, but abroad, right? Because once again, it's relative. So any change in the interest rate across the globe is likely to have some impact on in the US dollar, right? Because it's going to change that relative interest rate. Something else that matters a lot is relative risk. Okay, so what impact did COVID have on the relative risk of US assets? Who wants to make a guess here?
Got way more risky.
Way more risky. Yeah, market just tanked and tanked and tanked. Did they?
Well, in the beginning stages when everyone was scared, and then they started to rally heavy.
Yeah, what drove that rally?
Future, like I don't know, like future outlook and I thought it all turned around when we started to get news about the vaccine and stuff like that.
Yeah, I think that was part of it. But I also think there was very quickly a reevaluation that what COVID did is it actually reduced the relative risk of US assets. And the key word here, once again, is relative. Everything got more risky because of COVID. That's true. Everything got more risky. But the fact of the matter is that the US looked a lot better than Europe and other countries, many other countries, in terms of how we dealt with the crisis, or at least how our economy dealt with the crisis. So particularly, a lot of money left Europe and came to the US, particularly after those first couple of months, right? Because if you remember, the European economy really did relatively worse than the US economy during this COVID crisis. And so a lot of money really flowed to the US because, yes, absolute risk went up everywhere. But once again, the key word here is relative, right? Relative. So relative to the rest of the world, the US looked pretty good. And so what happens when you had a reduction in risk, relative risk? Well, I won't draw the graph, but it was one of the things that drove up the demand for dollars, because the US dollar looked relatively safe. And it's one of the reasons why the dollar has appreciated here quite a bit over the last year, right? This is related to the third thing we're going to talk about. Relative economic growth. If your country grows higher relative to other countries, what's going to happen? It's going to increase the demand for your currency once again. So you grow faster than other countries. I guess if I can connect the dots here, what's really happening is you're going to get a lot of capital inflows. A lot of investors are going to want to put their money in your assets and take place, try to get a part of those profits that are being generated. And that's going to tend to put an upward pressure on the dollar. And so I won't keep on drawing this graph, but it's really going to be this same graph. It's going to lead to an appreciation of the dollar. So once again, GDP last year went down in the US by 6%. Growth fell. But what happened? What was the performance of the US economy relative to most other developed countries? It was strong. It was relatively strong, particularly relative to Europe. And so, strangely enough, it was a good year for relative growth in the United States last year. And so this is something else that put upward pressure on the dollar, is that, a lot of money flowed into US financial markets, in part because of lower relative risk, in part because the US economy looked relatively healthy. Okay, so we've talked about three things here: relative interest rates, relative risk, relative economic growth. And then I want to talk about one other thing. And maybe of all of these things, this is the one that matters the most, at least in the long run. Relative inflation rates, right? Relative inflation rates. Okay, this one is going to take a little bit more time for us to talk about here. How is it that inflation impacts exchange rates? Well, the exchange rate that we've talked about, the exchange rate that you see mentioned in the paper, that is really a nominal exchange rate, right? A nominal exchange rate is the price of one currency in terms of another currency. But we could also think about what's called a real exchange rate. And we know what real means, right? Real means adjusted for inflation. Or another way of thinking about real in this case is it's really the nominal exchange rate adjusted for differences in the aggregate price levels. Between the two countries. Right? It's the nominal exchange rate, but it's adjusted for differences in the price level across different countries. Oops. Let's put it this way. So what is the real exchange rate? It is the nominal exchange rate adjusted for differences in the price levels. Man, I cannot write this one again. Right? So you could think about a real exchange rate as being the nominal exchange rate, but adjusted for differences in the relative price level between countries. Okay, that's what we mean by a real exchange rate. Now, how many of you have actually spent time traveling? I'm just kind of curious here. How many of you spent at least a fair amount of time overseas or whatever? Raise your hand. Okay, I know you have Zach, Sunny, yeah, a few hands. So those of you who have traveled abroad, you have calculated many real exchange rates in your brain. You've just never called it a real exchange rate, right? But when you travel abroad, you do this all the time. You calculate real exchange rates. So, you know, you go up to Canada and you see a sweater that costs 80 Canadian dollars. And what do? You're like, okay, well, this is 80 Canadian dollars. Let me think about, well, what's the US dollar exchange rate relative to the Canadian exchange rate? I adjust for that. And then I think about, well, is that then more expensive or cheaper than it is in the US, right? We do that all the time. We think about what's the price back in the US, what's the price in Canada, what's the nominal exchange rate, and try to figure out, is it more expensive in Canada or is it cheaper back home, right? We do this all the time. So while we put a formula here, don't be confused about this. This is really just a pretty simple idea that all the real exchange rate is doing is taking that nominal exchange rate and adjusting for the fact that prices are different between the two countries. So if you adjust for differences in the price level, right, adjust for the nominal exchange rate, you can figure out what the real exchange rate is. So let me give you an example here. Let's say there's a basket of goods. And this basket in the US is $100. And the same basket of goods in Mexico is 1,400 pesos. And the exchange rate is 19 pesos per dollar. What then is the real exchange rate? The real exchange rate is we take this nominal exchange rate 19 pesos per dollar. And we multiply it by the ratio of prices in the US to prices in Mexico. So notice here, for those, notice that the dollars cancel out, the pesos cancel out, and what do we get? 1900 divided by 1400. The real exchange rate would be 1.35. How do we interpret that? How do we interpret this? That US goods are 1.35 times more expensive than Mexican goods. That these US goods are more expensive. So if given the choice of buying these goods in the US or buying them in Mexico, you want to buy them in Mexico, right? It's cheaper in Mexico to buy these goods. That's what this real exchange rate is telling us. And like I said before, for those of us who have traveled, hopefully, you know, as COVID ends here, more of us will be able to travel. You will calculate a bunch of real exchange rates in your head because you'll do this. You'll think, what's the price in the US in dollars? What's the price here in terms of the other currency, right? Convert for the exchange rate. And then I figure out, well, is the real exchange rate greater or less than 1? Meaning, is it more expensive in the US or less expensive in the US? Now, why are we talking about this, right? I thought we were supposed to be talking about relative inflation rates. Well, the reason why we're talking about this in inflation rates is because this tells us if we understand the real exchange rate, we understand a lot about inflation rates. What determines the real exchange rate in the long run? An idea called purchasing power parity. Okay, purchasing power parity, boy, it sounds impressive. It's like one of those ideas that sounds really complicated, but in reality, it's a pretty simple idea. Purchasing power parity says the price of similar goods should be the same across countries. The price of similar goods should be the same across countries. Because what happens if it's not? People will arbitrage. Arbitrage is a fancy word, a fancy French word. Here in America, we know it as shopping. You look for a price difference. You take advantage of price differences. And the same should hold across countries. So what I'm saying here is that what happens if you found that a bunch of goods were cheaper in Mexico than they were in the United States? What are people going to do? I mean, we have a NAFTA, we have a free trade agreement between the US and Mexico. So if a bunch of things are a lot cheaper in Mexico, what are people going to do? Faith says you buy them from Mexico. That's it, exactly. People are going to buy things in Mexico and they're going to bring it back to the United States. Of course, how do you buy things in Mexico? You have to first purchase pesos. If everybody starts buying pesos, the demand for pesos will go up and the peso will appreciate, making Mexican goods more expensive, right? The price of the dollar will go down, making American goods more expensive, and the prices are going to equilibrize. Can't say that, equilibrize. Why can't I say that word? They'll get more equal between the two countries, right? And so the idea here is that if goods were a lot cheaper in one country, people will arbitrage. They'll take advantage of the price difference. They'll start buying things in Mexico and bringing them back to the US. They'll drive up prices in Mexico and drive down prices in the US until we get back into an equilibrium, right? So another way of saying this is what should be true about real exchange rates? They should be 1. The real exchange rate should be 1 in the long run. The prices of similar goods should be the same in the long run. Or we know from our formula that this is what the real exchange rate is, right? If this is equal to 1, then we can rewrite this as the following. The nominal exchange rate only reflects differences in the aggregate price level in the long run. In other words, the only thing that matters is inflation. Inflation is going to be the main thing that determines what your exchange rate is in the long run. Because if not, people will arbitrage. Yeah, Zach says, Zach used to live in Brazil. He said, you see arbitrage in Brazil with phones all the time. Absolutely. When I lived in Botswana, I mean, hardly a day went by when somebody didn't approach me to go to the US and buy a bunch of iPhones and bring them back to Botswana, right? And we'll talk in a minute about why people wanted to do that. But yeah, right, people are always trying to arbitrage, right? Where those price differences are the biggest, that's where people really want to arbitrage. And so yeah, as Zach says, they actually had an article on this in The Economist not long ago. iPhones are extremely expensive in Brazil, right? They're extremely expensive. And so yeah, there are big incentives to try the arbitrage. And so what that basically means is that in the long run, what determines your exchange rate is inflation. If inflation is higher in the foreign country than the US, what's going to happen? Well, if inflation's higher in the foreign country than the US, what's going to happen over time according to this formula? the dollar will appreciate, right? Our nominal exchange rate goes up according to this formula. And what happens if the opposite is true? What happens if inflation was higher in the US than it was in the foreign country? Then the dollar is going to depreciate. Right? So if inflation is higher in the US than it was in a foreign country, then the dollar would depreciate. Okay. Now, some of you might be asking, first off, hopefully this makes sense, right? I mean, setting aside the formulas and just stepping back here, using a little bit of intuition, it should make sense to you that when a country has a high inflation rate, its currency is going to depreciate, right? When you have high inflation, what should happen to the value of your currency? It should fall, right? So I think intuitively, this makes a lot of sense. Countries with high inflation are going to see their currency fall in value. Countries with low inflation low relative inflation are going to see their currency go up in value relative to other countries, right? So that's pretty intuitive, right? I think setting aside the equation, I think the intuition hopefully is pretty obvious. Now, some of you are probably asking, does purchasing power parity hold in the real world? Is it true that the prices of goods are the same across countries? Is it true that the real prices of goods are the same across countries? Well, you know, first off, it depends on the country. Is there free trade with the country? The more free trade you have with the country, the more likely purchasing power parity is to hold. So if you look at, for instance, the US and Canada, right? Which would be obviously two countries that are very close to each other. Right. What if you look at the data? Nope, sorry. That's not the one I want to look at. Look at this. The kind of light blue, light green line is the nominal exchange rate between the two countries. But the purple line is the real exchange rate. Notice that the real exchange rate between the two countries is pretty steady, right? Meaning the exchange rate adjusted for differences in inflation is pretty steady. But it's not exactly equal to 1, right? It's not exactly equal to 1. It's close to 1, but it's not exactly equal to 1. So, in other words, purchasing power parity holds perfectly, but there are some limits to purchasing power parity. In other words, sometimes you do see goods that are significantly more or less expensive in different places. So give me an example. What kind of things might prevent purchasing power parity from occurring, or might keep price differences from disappearing between countries? Any ideas about what could be driving these price differences? Well, let me rephrase the question. Actually, hold on, somebody chatted. Sunny says cost of living. Well, cost of living is inflation, right? So we would expect our exchange rates to adjust to differences in inflation. Let me rephrase the question. Purchasing power parity shouldn't just hold between the US and Canada and Mexico. It should hold between Mount Vernon and Chicago, right? I mean, you can arbitrage between Mount Vernon and Chicago. Is there purchasing power parity between Mount Vernon and Chicago? Well, yes and no, right? Yes, like a whole bunch of goods are pretty similar between Mount Vernon and Chicago. But then I think we can also think about some goods that are much different in price. What are some of the goods that are much different in price between Mount Vernon and Chicago?
Paying for parking.
Paying for parking, yes, right. Related to that is housing. What's the problem with parking and housing? Can you arbitrage parking between Mount Vernon? Yeah, right? You can't. You can't do that. Some goods are not movable. And the classic example is housing and parking, right? You just can't say, well, houses are more expensive in Chicago and they're cheaper in Mount Vernon, so I'm just going to take my house and move it to Chicago, right? That doesn't make any sense. You all have probably heard of the old adage, what are the three most important things in real estate? Location, 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 right? What are they telling you? Purchasing power parity doesn't hold in real estate, right? Purchasing power parity doesn't hold, right? There's going to be big differences in price levels between different places because you can't arbitrage in the same way that you can for a can of Coke, right? What are some other goods that are a lot more expensive in Chicago than they are in Mount Vernon? Services, yeah, what kind of services?
Are like Uber, and I mean, when I went to New York, like, and I don't know, the Uber from the airport to my hotel was like $60.
Yeah. So actually, Uber in general, the service for Uber, as I understand it in New York, is not really significantly different than it is in Mount Vernon. However, there is one factor that almost certainly drove up your toll from the airport to getting into Manhattan, and that is all those fees that you have to pay to cross the bridges, right? And so, of course, that's something else. Any tariff or tax or toll, right? Those kind of things are also going to drive differences between prices, right? So that's a big part of it, right? That is certainly a big part of why those Uber drives into Manhattan are so expensive, because you can easily pay 10 or 12 or more depending upon time of day, because those tolls are actually timed to the time of day. So depending on the time of day you can spend a lot of money on tolls. One thing that many people talk about is, there's also transaction costs to doing this. And so you have to consider those when you consider purchasing power parity as well. Is gas cheaper in Iowa than it is Chicago? Yeah, in part because of taxes, right? Gasoline taxes are higher in Illinois than they are in Iowa. But could you take advantage of this if you lived in Chicago by driving to Iowa to buy your gas and then driving back to Chicago? I mean, right, that doesn't really make a lot of sense, right? When you think about the transaction cost of doing that, including your time, that's not gonna stop things, right? Or that's not going to provide much of an incentive to do that. So anyway, so you have to think about purchasing power parity is a rough approximation of the way that the world works, right? It's not a perfect description, but it's a rough approximation. The key thing, though, that purchasing power parity tells us is that inflation is the big thing that drives exchange rates in the long run. So if I told you that Japan over the last 20 years has averaged about 1% inflation, and that the US has averaged about 2% inflation, what can I tell you? What are you going to tell me about what's happened to the exchange rates between the two countries? If inflation has been 1% in Japan and 2% in the US, which currency has tended to appreciate? Right? If inflation is 1% in Japan, 2% in the US, which country is going to appreciate? Hello? Zach says Japan? Question mark? Yeah, Japan, right? Low inflation countries will see their currency appreciate. High inflation countries will see their currency depreciate. So in general, the dollar has depreciated against the yen for the last 20 or 30 years, right? Vice versa, the dollar tends to appreciate against the Mexican peso. Why? Because inflation is higher in Mexico than it is the US. So these four things are big factors. These four things are the big factors that shift the demand for dollars. Relative interest rates, relative risk of US assets, relative economic growth, and relative inflation rates. Now, that's the things that shift the demand for dollars. What shifts the supply of dollars? And the big thing is monetary policy. And so that's what we want to talk about when we come back from break. How exactly does monetary policy impact exchange rates? Okay, so we will pick up there after we take a break. So let's maybe meet back here at 10:15, okay? All right, have a good little break. Okay, folks. So Nevaeh, is that really just something out of one of your nightmares, that cat? Is there a story here behind that gruesome cat?
No, my roommate and I just liked saving pictures of cats.
Are you eating that cat? Is that a real cat, or is that like some sort of CGI cat from some horror picture? All right. Well, maybe the cat got Nevaeh's throat. We will hear no answer to that. So, all right. So let's talk about let's talk about what's going on here and how monetary policy impacts exchange rates, because that's the last big part of this puzzle, right? And it is a big part of this puzzle, right? If we think about exchange rates, the last thing we have to talk about is what determines the supply of dollars or the supply of a currency. And that is, of course, monetary policy. Monetary policy plays a big role in shaping exchange rates. So let's make sure we understand how this works. Let's think about an example where, for instance, the Fed conducts an open market purchase. Well, if the Fed conducts an open market purchase, it's really important to recognize that two things are going to change here that impact the exchange rate. Right? Not just one thing, but two things are going to change here. The first is that the money supply is going to go up, and this will increase the supply of dollars. But something else happens here. The federal funds rate is going to go down. And when interest rates go down, this actually reduces the demand for dollars. So when the Fed conducts a change in policy, it's not just shifting the supply curve, it's also shifting the demand curve at the same time. Right? So here's our market for dollars. What happens if there's an open market purchase? Supply of dollars goes up, demand for dollars goes down. And notice that the dollar will depreciate. So when the Fed increases the money supply and drives down interest rates, they're also doing something in the foreign exchange market. They are depreciating the dollar. And it works the same way in reverse. What happens when the Fed conducts an open market sale? They're reducing the money supply and raising interest rates. The fall in the money supply reduces the supply of dollars. Higher interest rates reduce the demand for dollars. I'm sorry, said that backwards. Increase the demand for dollars. And so what happens in our market? Supply of dollars goes down, demand for dollars goes up, and the dollar appreciates. So monetary policy has a big influence on what the exchange rate is through this process. And I think the key thing here to remember is it's not just through shifting the supply of dollars that monetary policy matters. It also matters by shifting the demand for dollars, because the Fed plays a big role in what interest rates are. And so it's also through the changing of the demand for dollars that it influences the value of the dollar, right? Not just through the supply. So this is how central banks can manage exchange rates, right? One goal of monetary policy can be fixing your exchange rate. Central banks, and some central banks actually do this, choose as a goal of their monetary policy to fix their exchange rate. In other words, just as the Fed will fix the federal funds rate, the Fed could also choose, if they wanted to fix the value of the US dollar. So let's think about how this would work, right? Let's not think about the US, but let's think about what should we say? Let's talk about the market for RMB. I don't want to use that either. Right, we'll talk about a magical currency called NOOPS, all right? Because I can't think of anything more clever. If you had a country that had a currency named NOOPS, so they had the supply of NOOPS, the demand for NOOPS. Why did I choose my own name? This is already annoying me.
Dogecoin.
The problem with picking the problem with picking a real world example is that it starts to bring in too much real world crap. How about ZAC coin? All right, so we have a country that issues ZAC coin, right? And here's the exchange rate for that currency, right? Let's say, though, that the central bank would like to keep the exchange rate down here. In other words, XR is their targeted exchange rate. What's the policy that this central bank should follow? If they want to fix the exchange rate, and right now notice that the exchange rate is too high, what do they have to do to drive down the value of their exchange rate? What do they have to do to depreciate their exchange rate? Scroll up, or not scroll up, but look back at your notes, just what we had up here a minute ago.
A purchase.
They would purchase.
Open market purchase, right? They would conduct an open market purchase to increase the money supply and reduce interest rates. What would happen? Demand for dollars would go down and supply of dollars would go up. And that will drive down the value of their currency. What about the opposite case? I'm going to draw this same graph here. But let's say here, here in this case, that the exchange rate is below their target. What's the policy that this central bank should follow in this case? Now they want to drive up the value of their currency. How do they drive up the value of their currency? Open market sale, right? To decrease the money supply and raise interest rates, that will decrease the supply of dollars and raise the demand for dollars. And if they do this right, they will move the exchange rate right up there. Okay, so a central bank, listen, we've talked mainly about the Fed, and we've talked about the goals of monetary policy that the Fed follows. The Fed tends to follow, try to keep inflation stable, try to keep output high. But they could also choose as a goal of monetary policy fixing their exchange rates, right? The Fed could do this. What it would mean is that they would have to use monetary policy as a means of pushing the market exchange rate, the market for the dollar, in such a way that the exchange rate would stay constant. Okay? Now, why would a central bank do this? Let's talk about this. Because every central bank basically has to make a decision about whether they want to fix their exchange rate, meaning having a targeted exchange rate, or whether they want to float their exchange rate. And when people talk about floating your exchange rate, you're basically meaning you're having a market determined exchange rate. You're just letting supply and demand determine the exchange rate. So let's think here about fixing. The advantages of fixing, but then of course, as anything in economics, there is nothing that is universally good or bad. There are just trade-offs, right? And so when it comes to fixing, there are some big advantages, but then there are some disadvantages, right? So help me out here. Why might a central bank decide that they would choose to fix their exchange rate? What's the advantage of fixing your exchange rate?
If you're a country that imports or exports a lot, one or the other, not both, you can fix your currency to benefit either the importers or exporters.
Yeah, right. But I don't think you want to think about it as necessarily creating winners or losers. Both importers and exporters would benefit from exchange rate stability, right? I mean, regardless of whether you're exporting or importing, having a volatile exchange rate creates a lot of risk. One of the things I should have mentioned here at the beginning is that exchange rates tend to be very volatile, right? They tend to move up and down. So for instance, just to give you some idea, The dollar against most major currencies has appreciated by about 10% over the last year. So that 10% increase means that the price of US exports have gone up by 10%. Okay? That is very costly. But likewise, falling by 10% can be costly, right? There's a lot of instability, there's a lot of risk. And so one of the advantages of fixing is you're really reducing exchange rate risk. With the idea that this will encourage international trade. Whether you're importing or exporting, it will be a good thing. So many countries do this. It's essentially a way of creating stability in international trade. But very importantly, as we talked about yesterday, it's not just trade in goods and services that's going on between countries. What else is this going to facilitate? Right? Not just trade in goods and services. What are the other kinds of transfers that are going on between countries?
Ideas.
Well, yeah, there are ideas, but foreign direct, as Sunny says in the chat, foreign direct investment, right? Right? This same stability will also encourage foreign capital flows. Money coming in, money coming out. This is really important. So for many countries, foreign capital flows are more important than trade flows. For instance, South Korea fixes to the US dollar, even though the US is not their largest trading partner. Japan is their largest trading partner. If South Korea is fixing to the dollar, but Japan is their largest trading partner, why would they be doing that? Well, because they're not primarily interested in trade, they're interested in capital flows. And most capital flows take place in dollars. And so that tells you which of these two things Korea views as most important, right? They view making sure that capital can flow freely in and out of their country is the most important thing to them. And so that's why they fix their dollar. So this stability that this creates is really important for some countries, right? Of course, what's the disadvantage of fixing? Help us understand this. What's the disadvantage of fixing? Well, it doesn't, yeah, Sonny, it doesn't reflect real demand and supply. I'm not sure I would say it like that, but I see your point. I'm going to set that to a side for a second. Before we talk about that, I think there's a couple of other things we should talk about. What's the primary cost of fixing? If you are setting monetary policy based on keeping your exchange rate constant, what can't you do with monetary policy? There's an opportunity cost of this, right? If all you're going to do is fix your exchange rate, what can't you do? I can't read your lips, Krista. I see you talking.
Any other policy?
You can't do anything else, right? You can't. You can't. You can't really conduct independent stabilization policy, right? You have to kind of give up control over the money supply and interest rates and even inflation, right? Everything has to essentially serve the master of fixing your exchange rate.
Can a country like unfix its exchange rate? Like,
sure, you can give up, you can abandon your peg, or this is often referred to as devaluing, right? Yeah, you can do that. Now, let me take this one step deeper. There's also another problem of fixing, which I think this is what you were getting at, Sunny, in some of your comments in the chat. If you're doing this, most countries cannot just buy and sell their currency domestically and have any real control over the exchange rate, right? Most countries conducting open market purchases and open market sales of their own domestic bonds is simply not sufficient to sufficiently impact these markets. So what countries end up having to do is smaller countries end up having to buy and sell foreign assets. That's how they end up controlling their own exchange rate, is buying and selling not their own bonds, but they have to buy and sell foreign assets. In other words, they end up holding billions in foreign reserves. And these things have a large opportunity cost. Right? Many countries are holding trillions of dollars of foreign reserves, meaning basically much of this is US assets, US treasury bonds. They're holding these treasury bonds because these are the things that they can buy and sell in the market to influence the value of their currency. But there's a huge opportunity cost of that. Right? There's a huge opportunity cost. They end up spending billions of resources holding these reserves. The other problem is you can run out of reserves. And without getting into the details of this, undergo what's called a currency crisis, which could lead to a big fall in your currency. It can lead to a big fall in your currency. And so whenever you fix the exchange rate, I think this is what you were getting at, Sunny, when you said, whenever you fix, it may not reflect the real demand and supply. Yes, in the sense that if you get too far, if you think back to these graphs, if your target gets too far away from where the market says the exchange rate could be, right? You get too out of whack, you could end up holding way too many foreign reserves or not holding enough foreign reserves to be able to sufficiently maintain your target. And that's what a currency crisis is when a central bank fixes and then they figure out, oh wait, I can't fix anymore. And as a result, the market goes bonkers, right? Because the market had expected one thing and then they find out that what they thought was going to be true is not. It's kind of like debt tolerance, right? Exchange rate tolerance. If once you lose confidence in a currency, then you're going to have a lot of capital flight. People will pull out of your currency, right? People will pull out of your country. The currency will drop a lot. I mean, it's usually a disaster, right? So these are some of the disadvantages of fixing. So like everything in economics, there's a cost and a benefit, right? There's a cost and the benefit. So having kind of understood this, who tends to fix? And who tends to float? What kind of countries tend to fix their exchange rates, do you think? So remember the advantages. The advantages are you really are encouraging trade in foreign capital. The disadvantages are you kind of give up control of monetary policy. So who is going to tend to fix? Faith says poor countries fix. Yes. Why? In general, they're more reliant on trade. So related to this, smaller countries, countries with one major trade partner, these are the countries that are going to be most likely to fix. These countries that are smaller, poor, one major trade partner, right? Let me give you a couple of examples of countries that fall into this category. Some of you might have gone to the Bahamas, right? One of the things you know is that the Bahamas actually has a fixed exchange rate with the dollar. It's actually a $1 to $1 fixed exchange rate. One Bahamian dollar equals one US dollar. Why does the Bahamas have a fixed exchange rate with the dollar? Quite simple. Bahamas economy is completely linked to the US economy, right? Because of trade, because of tourism, largely, right? Most of the Bahamian economy is US tourists. So for them, there is no advantage of having independent monetary policy. The only thing that matters for them is they want to encourage trade with the United States. So what do? They fix to the dollar, right? They fix to the dollar, and they make it easy for tourists to come and visit them. So Bahamas would be a great example of that. When I lived in Botswana, I worked for the Central Bank of Botswana for a while. Botswana, in its own way, was in a similar situation. For those of you who know where Botswana is, it's in Southern Africa, right by South Africa. Botswana is a pretty big country geographically, but a small country in terms of number of people. It's only about 3 million people. And it's right next to South Africa, which is many times bigger. The Botswana economy is completely linked to South Africa. So what did the Central Bank of Botswana do? They fixed to the South African rand. And that makes sense, right? Their whole economy is tied to South Africa. There's very little advantage to them of having independent monetary policy. So they just fix to the South African rand, right? That's kind of what they see as the biggest benefit that they can get from monetary policy. But it means giving up everything else. And, having worked in the central bank, it was frustrating, right? Because it basically meant that whatever the South African central bank did, Botswana's central bank had to do. And that's frustrating because, sometimes they didn't always want to do that, but you kind of have to follow the leader in many ways. Who tends to float? Well, it's the opposite. It's the bigger, richer countries that tend to float. And for these countries, there is more of a value of having independent monetary policy. So for instance, the US is kind of special. The US just basically floats and they let other countries fix to the dollar. It's good to be the US, right? I mean, because the dollar is the international currency, many countries choose to choose to fix to the dollar. And so the US in many ways gets the advantages of fixed exchange rates, but we don't have to do anything. It's the other countries that fix to us. We are the US, we do whatever the hell we want. Of course, this does create some consternation and a little bit of resentment among other countries, right? Because the US kind of is always doing what it wants in monetary policy. It doesn't really spend a lot of time thinking about the consequences for other countries, particularly countries that tend to fix. And who are those other countries? They tend to be poor countries for which the US is their biggest trading partner. So, for instance, South American countries all the time are complaining about US monetary policy, as they probably should, because the Fed runs monetary policy in ways that it sees are in the US best interests, but doesn't think about the collateral damage on many other countries who try to fix to the dollar, right? So that's kind of the trade-off between fixing and floating. Let me just say one more other thing about this is that there is an alternative to fixing and floating, and that's a monetary union. And a monetary union in some ways is a fixed exchange rate system. It's a fixed exchange rate system in which you essentially have the same currency that has a one-to-one value with the currency from every other member country. So if you think about the European Monetary Union, there's 11 separate central banks in each member country. And then there's an executive board that coordinates monetary policy among the 11 separate central banks. And a euro printed up in France is equal to a euro in Germany. It doesn't make any difference where the euro is printed up. There is a fixed exchange rate on a one-to-one basis. So this is the European Central Bank, which is these 11 central banks and then the executive board. Does this look at all familiar to you?
It's like a better version of the original Fed.
Yeah, right. It is the Fed. In many ways, the European Central Bank is modeled exactly after the Fed. Just like we have those 12 regional banks, and then we have the Federal Reserve, the Board of Governors. The European Monetary Union is basically the same setup, where there's 11 separate central banks, but then there's this executive board, right? That essentially coordinates all these regional banks. And so it's very similar to the Fed, right? Very similar to the Fed. Of course, there's a big difference. And that big difference is the European Central Bank has an inflation rule or an inflation target. Unlike the Fed that has flexibility in what they want to do, the Fed can kind of focus on output or focus on inflation or whatever. The European Central Bank has a lot less flexibility. Their goal is 2% inflation. Whoa. Right? Their sole goal of monetary policy is 2% inflation. So in many ways, they have a lot less discretion or flexibility in how they set monetary policy. And in some sense, you know, that makes sense, right? Because you basically have 11 separate countries that are not nearly as integrated as the 50 US states, right? So you have there's a lot of differences between these countries. And as we talked about, it's really hard to think about how central banking should work when you have 11 different countries. And so what the framers of the European Central Bank said is, well, we'll just keep it simple, just focused on inflation, right? Just keep it simple, focus on inflation. And, you know, that makes some sense. But of course, there's also some pretty big limits to this setup, that the European Central Bank just has less flexibility. And when there is a crisis like what we saw during the Greek debt crisis, the European Central Bank really wasn't able to do a lot, right? Unlike what we've seen in the US during the COVID crisis or during the 2008 global financial crisis, where the Fed has been able to act very aggressively, the European Central Bank hasn't been able to do much during the COVID crisis. They didn't do much during the Greek crisis, right? There's not much they can do other than keep inflation steady. And so, I think you can see, once again, the costs of this, right? I mean, there's some benefits to the way that the European Central Bank is set up, but there's some costs to it as well. And so, it'll be interesting to see how this plays out over time. I'm kind of amazed that it's worked as well as it has, but it hasn't always worked great, right? And it will be interesting to see if countries can keep up with this union, right? Because there are definitely tensions all the time, and particularly when you have some sort of economic crisis, there's a lot of tension for the European Central Bank to do more, kind of like the Fed does more. But the European Union, the European Monetary Union, as it's set up, doesn't really give a lot of flexibility to monetary policy. Right? Policymakers don't really have a lot of discretion to choose what they do, and they certainly can't, give bailouts or these aggressive things that we've seen the Fed do. Okay, all right. So that's really chapter 18. We did it, right? With 9 minutes to spare. Look at me, right? 9 minutes to spare. I know, it's quite 18 days, and I'm giving you guys back 9 minutes. So go enjoy that 9 minutes, right? Go have a blast with those 9 minutes. We'll see you back here at 12:30. Remember, all we're going to do this afternoon is to talk about the final and to review. So please bring some questions if you have them. But if not, anyway, we'll see you back here at 12:30, okay? Sunny, I never had a chance to, you had this long question in chat. I can talk to you if you want to hang out. I can talk to you here about it.